Welcome back, everybody. My name is James Faulkner, and I'm joined by Stewart Heggie of Scottish Mortgage Investment Trust. Welcome to the show, Stewart.
Thank you very much. Great to be here.
Have you? Congratulations on what's been an absolutely phenomenal year for Scottish Mortgage. Baillie Gifford, it's got a bit of a different ownership structure, hasn't it, to lots of other investment management firms. Can you tell us a bit more about that and how that affects the investment philosophy?
Yes, well, Baillie Gifford is a partnership, and it was formed in 1908. And in fact, the first client of Baillie Gifford was in fact Scottish Mortgage in 1909. And the main difference between other investment management firms is that many of them have outside owners, and they will have to think about the concerns of of their shareholders. Thinking about short-term profitability. We have the ability to think long-term, and that aligns us to our client interests. So what's important about the partnership is that all of the owners actually work within the business. So they have the ability to think about the long-term and manage the business in line with the client investment horizons.
Skin in the game, so to speak.
Yeah.
So what's Scottish Mortgage trying to achieve for its shareholders?
That's a good question. Scottish Mortgage is trying to achieve long-term growth for its clients. And the way that we approach this is by being resolutely optimistic. What we're trying to do is find companies that are addressing huge markets, and then they possess a competitive advantage in going after those markets. And then on top of that, we're also looking for businesses that are sustainable and will last for many decades.
What's the investment horizon for Scottish Mortgage in terms of the portfolio constituents? Is it buy and hold forever like Warren Buffett, or how does that work?
Well, I'm not quite sure it's buy and hold forever. Our investment horizon is 5 years and beyond. And I suppose we currently live in a day where the average holding period of a stock within a fund is less than 2 years. We think 5 years and beyond is quite important because it's over that time period that business fundamentals start to really play out, that management teams can really start to show what it is that they are doing. Nowadays, over 2/3 of our portfolio have been held for over 5 years. And in fact, there are a number of holdings that have been held for a decade or more.
And I suppose for companies such as Tesla that are kind of really, long-term plays, it takes a long time sometimes for an investment case to come to fruition, doesn't it? So if you can, buy and hold right from, the early days and sort of allow that value to be crystallized over a long period of time, shareholders can really sort of see the long-term benefits from that, can't they?
Absolutely. We first bought Tesla when it was worth $7 billion, and that was in January 2013. And I think one of the things that I should highlight is really the value of endurance. So shortly after buying Tesla, it actually fell by 40% in value. And believe it or not, it's actually fallen by in excess of 30% on 10 occasions throughout ownership. So we have to be able to really put up with these ups and downs and really see beyond it. And the big challenge is really to just turn off the Bloomberg screens, ignore the short-term news flow, and really concentrate on the company fundamentals.
Yeah. And presumably that requires a really high degree of conviction as well, doesn't it, to hold on to those positions when they fall in like that in, 30-40% drawdown.
It does. Yes, it's Scottish Mortgage is a high conviction portfolio, so we can hold between 50 and 100 stocks within the portfolio. It tends to be about 80, but to give you an idea, about 80% of the overall holdings within the portfolio are held in the top 30 names, and about half of the allocation are held in the top 10 names.
You mentioned China, and the company has got quite significant exposure to Chinese stocks. We saw recently the flotation of Ant International suspended by Chinese authorities. Does behaviour such as this make you at all uncomfortable about your investments in China? Is it a concern?
Well, we think that China is is misunderstood. And as a growth investor, it cannot be ignored. Many people see China as being the factory of the world or government controlled. But when people make these broad generalizations, they're missing out on big opportunities. So to just give you some examples, the United States has 10 cities in it that have populations in excess of 1 million. Whereas in China, there are 102 cities with over 1 million people living in them. And this is a country which has experienced a 50-fold rise in its per capita GDP over the last 40 years. So there's hundreds of millions of people that have been lifted out of poverty. And it's also potentially the most vibrant center of innovation anywhere in the world. But what is really exciting is that the consumer consumption story has barely even got started there. So we are looking for markets where we can see extraordinary amounts of growth. So you can think about companies like Meituan, Dianping, which does home food delivery. So to draw some parallels with the United States against Grubhub is the leader there, and that delivers about 500,000 meals a day. Meituan Dianping delivers 30 million meals a day. And we met with the chief exec earlier on this year in the summer, and I quite like the way that he termed it. He said there are 800 million people living in an urban environment in China, and they are eating 3 meals per day. So it feels as though we've got some we've got some way to go in that growth story. But on top of the food delivery, because they became such an essential part of society during the pandemic, they've actually then branched out into grocery deliveries. So just a couple of years ago, they weren't even doing this, and they're already making 10 million grocery deliveries per day. Now, if we turn onto Ant Group, yes, the IPO has not gone through. What we can say about Ant is that they are a truly extraordinary business. There are basically two parts to a fintech business. And if you unpack those, first of all, there's transaction processing, and they process more transactions per day than a multiple, in fact, of those that Visa do. And the second part is artificial intelligence basically replacing human judgment. And via your smart device with Ant Group, you can basically borrow, save, insure, or you can even run the entire finances of your small business. Now, Ant have a very long and good record of dealing with the regulators, the financial regulators in China. So it came as a surprise to us, this IPO being withdrawn. But I think one thing that we have to take into consideration is for the additional capital that was offered out to end Chinese investors, this was oversubscribed by hundreds of times. And we're not quite sure what role that has played in it. So we're continuing to talk to Ant, and we imagine that they will list at some stage. But the benefit of being a long-term investor is that it actually doesn't really matter for us. We're planning on holding this business for a very long period of time.
And speaking of growth markets, the pandemic is generally seen to have accelerated the pace of development in the healthcare sector. To what extent do you think that we might be on the cusp of a new golden era in healthcare, and which particular opportunities is Scottish Mortgage looking at to sort of take advantage of that?
You're right to point to healthcare, and it's particularly where data and artificial intelligence meet healthcare. So one of our leading holdings is Illumina, which is a leader in DNA sequencing. So if we think about 20 years ago, the Human Genome Project, so that took billions of dollars and a couple of years to map one human genome. And then if we fast forward to the SARS epidemic, then it took about 6 months to map the sequence there. But whereas with COVID-19, it actually took a small number of weeks, largely down to this technology. So now as we sit here today, because that has been mapped out, we already have a number of vaccines that could be used. So it matters a great deal. Now, beyond that, we have a number of other investments. And again, it comes down to using data. So we have Grail, and Grail is a company that with a single test, you could basically identify it's about 15 different types of cancer. Or Denali Therapeutics. This is using technology to basically try and stop human degeneration in a way. So it's attacking things like Parkinson's and Alzheimer's disease. So the use of data in healthcare could be hugely beneficial. Now, beyond that, holdings that we don't have, but we have been looking at are where I suppose AI can help support doctors. So, in the pandemic, we've all been locked within our homes, and there are certain companies out there that are basically acting like an artificial doctor, which means that GPs can actually spend more time with the people that they actually have to. So we think that the opportunity in healthcare is certainly long run.
So we've seen the announcements regarding the success of various vaccines recently, and that's obviously provoked a big buy into the sort of value side of the market. To what extent is this a bit of a near-term headwind for you guys? Because you're all about growth, aren't you? And value doesn't really sort of play a big role in the portfolio, does it?
Well, I suppose valuation is quite an interesting topic, because we do think that valuation is quite important, but we don't think that any company set out to be growth or value stocks. They're simply companies. The way that we view valuation is we look at a company and we look at their long-term free cash flows, and that is simply it. Now, when it comes to the normal home for a value investor, this is all down to reversion to the mean, expecting something can come back up to a certain level. Whereas what we are looking for are companies that can grow exponentially. So whilst certain stocks have recovered over near times, we're taking a 5 to 10 year view, and it doesn't really bother us.
And is there any sort of geographic or sector limits in there as well?
No, this is a pure bottom-up stock picking portfolio. If anything, we would regard the index as being the risk out there, because there are huge swathes of capital held up in certain sectors where we don't think that there is a great outlook. So the Scottish mortgage portfolio has an active share in excess of 90%, usually, so it's 90%, unlike the index, and we don't have any geographic or sector limits.
Right. And you also invest in private companies, don't you? And there are limits for this allocation, aren't there?
There are. We received shareholder approval following the AGM earlier on this year, and that's that we're now allowed to invest in 30% in private companies at the time of investment. And to just break it down for you, at the moment, we currently have 17% held in private companies. But I think what is a key USP of Scottish Mortgage is we have the ability to hold those companies through IPO once they become public. So there's a further 19% of the portfolio that's held in those companies. So there's 17 plus 19. We currently have 36% of the portfolio in companies that first started when they were private.
And what about the company's use of gearing? Because obviously this is borrowing money to then invest. How does the company approach that?
Yeah, we see long-term borrowing or gearing as being a distinct advantage of investing in an investment trust. And the approach that the board takes at Scottish Mortgage is to be about 10% strategically geared over the long term. In more recent times, that amount has actually fallen in recent months. So, but that's not a reflection of our outlook. It's simply that the portfolio has increased in value in quite a short space of time, and in time we'd expect to return to that 10% position.
Okay. Scottish Mortgage, obviously you've had a lot of success over recent years. Can you tell us some of the things that you might have actually got wrong?
This is a really good question, because it comes down to optimism. The way that the managers approach investing in Scottish Mortgage is that they are looking for the outliers. They're looking for companies that can become a multiple of the size that they are today. So when they consider things that have gone wrong or potential mistakes, it's not the companies that they've actually lost money in, because that is just a natural consequence of investing. Where they see where they might have gone wrong are potentially companies that they have not bought that have increased in size, or indeed companies that they could have bought earlier. A couple that, say, Tom Slater has cited over the years would be Airbnb, who he met about 3 years prior to investing, and it's since grown a lot. Or in fact, Netflix. That was a company where the investors felt quite confident about, but couldn't just quite get themselves over the line in their 10-question frameworks. We bought it about 2 or 3 years later, and it's grown quite a way in that period of time.
And how important are costs to the overall total return? Because a lot of investors overlook this, don't they? But in fact, costs over a long period of time can make a big difference to total return, can't they?
Absolutely huge difference. And one of Scottish Mortgage is now an investment trust that's it's worth in excess of 15 billion pounds sterling, and we share those benefits of scale with our end investors. So the costs of investing in Scottish Mortgage now are 0.36%, so 36 basis points. And once we take into consideration the costs, the normal costs incurred of investing in private companies, we feel that this is unmatched compared to any other cost basis.
And what about ESG? Because this is now becoming a really big factor for investors looking at their investments, isn't it? So how does Scottish Mortgage approach this?
That's a really good question, and it's one that we're being asked more and more often. We view ESG as being critically important, but we do not find the current methodologies or measurements to be particularly helpful in that regard. It's effectively a box-ticking exercise, and we feel it's quite dogmatic. And it's often just focused on the short term. I mentioned earlier the normal 2-year holding period. We're holding companies for 5 or 10 years or beyond. And when you're doing that, you really are starting to think about the societal benefits of underlying companies. So this is leading us into areas such as improving healthcare, or electric vehicles, or just general, the end of carbon and energy transformation. And I think it actually goes slightly deeper than that. We don't really think it's particularly relevant how long someone has sat on a board if they're actually quite beneficial, to that company. And some would criticize the amount that certain chief executives get paid. We are very happy for the rewards to be large for company executives if the payoffs are very large for that organization, and we would support that.
Okay, thanks for your time today, Stewart. And don't forget, everybody, that you can learn more about Scottish Mortgage at the exhibition booth. So do go and check that out. And also, Stewart will be back tomorrow with a presentation on Scottish Mortgage. So obviously, tune in for that one, guys. So thanks very much.